Accounting forms the foundation of all financial reporting and fraud examination activities. It is the systematic process of recording, classifying, summarizing, and reporting financial transactions to support decision-making by management, investors, creditors, and regulators. The core of accounting is the accounting equation: assets equals liabilities plus owner's equity. This equation ensures that every transaction maintains balance through the double-entry accounting system. Assets represent resources owned by an entity that provide future economic benefits, while liabilities represent obligations owed to external parties. Owner's equity reflects the residual interest in the entity after liabilities are deducted from assets. Understanding this relationship is essential because all financial reporting and financial analysis ultimately stem from this fundamental accounting framework. The accounting cycle transforms business transactions into meaningful financial information. Every transaction begins with source documents such as invoices, receipts, purchase orders, or checks. These documents provide evidence of economic activity and become the basis for journal entries. Journal entries record transactions chronologically using debits and credits, creating a clear audit trail. Entries are subsequently posted to individual ledger accounts, where transactions are accumulated and summarized. At the end of an accounting period, adjusting entries ensure revenues and expenses are properly recognized. The resulting account balances are then used to prepare financial statements. Because fraudulent activities often involve manipulation of accounting records, fraud examiners must understand each stage of the accounting cycle and the documentation supporting recorded transactions. Organizations generally use either cash basis accounting or accrual basis accounting. Under cash basis accounting, revenues and expenses are recognized when cash is received or paid, making the system simple and easy to administer. However, this method can distort financial performance because economic events may not be recorded in the period in which they occur. Accrual basis accounting, which is required under GAAP, records revenues when earned and expenses when incurred, regardless of cash movement. This approach recognizes accounts receivable and accounts payable and better matches revenues with related expenses. As a result, accrual accounting provides a more accurate representation of an entity's financial position and operating performance, enabling stakeholders to make more informed economic decisions. Financial statements summarize the results of accounting activities and communicate an organization's financial condition and performance. The balance sheet or statement of financial position presents assets, liabilities, and owner's equity at a specific point in time. The income statement reports revenues, expenses, gains, and losses over a reporting period, ultimately determining net income. The statement of changes in owner's equity explains movements in equity resulting from profits, losses, investments, and distributions. The statement of cash flows categorizes cash movements into operating, investing, and financing activities, helping users understand how cash is generated and utilized. Together with accompanying notes and disclosures, these statements provide a comprehensive view of an organization's financial health and operational effectiveness. Financial statements serve numerous stakeholders, including management, shareholders, lenders, investors, regulatory agencies, vendors, and customers. Because these users rely heavily on financial information when making decisions, accurate reporting is critical. Fraudulent financial statements can mislead stakeholders regarding profitability, solvency, liquidity, and future prospects. Consequently, organizations must follow generally accepted accounting principles GAAP, which establish standardized rules and procedures for recording and reporting financial transactions. GAAP promotes consistency, transparency, reliability, and comparability across reporting entities. While accounting frameworks vary among countries, efforts toward global harmonization have led many jurisdictions to adopt International Financial Reporting Standards (IFRS), although some countries, such as the United States, continue to maintain their own GAAP systems. GAAP is built upon several fundamental accounting principles that guide financial reporting. The historical cost principle generally requires assets to be recorded at acquisition cost rather than current market value. The revenue recognition principle requires revenue to be recorded when performance obligations are satisfied and control of goods or services transfers to customers. The matching principle requires expenses to be recognized in the same period as the revenues they help generate. Consistency requires accounting policies to be applied uniformly across periods, while full disclosure ensures that all material information necessary for informed decision-making is reported. Additional concepts such as conservatism, materiality, substance over form, and cost-benefit considerations help accountants exercise professional judgment when unusual circumstances arise, ensuring that financial statements fairly represent an entity's economic reality.